Many traders believe that if they don't have a large option trading account, they actually can't trade options. That's actually not true. In fact, the opposite is the case. You can actually trade options with an account as small as $1,000. In this video, I'm going to share with you 4 strategies I use in my small option trading account. My name is Randy Perez. I'm a 20+ year stock and option trader. I'm excited to share with you these 4 strategies I use in my small option trading account. As always on this channel, I use my real life trades. I don't make some up. I show you the good and the bad. To me, that's an important part of trading. You have to know how to deal with trades when they go against you. But first, let's start with a trade that went our way in my small account. Here you see that on October 17th, we sold the IWM Bullish Put Credit Spread. We sold the 208 put and bought the 206 put for protection. Now for that, we received a net credit of 32 cents per share. This is the first option trading strategy I use in my small account, and I use it a lot. That's a bullish put credit spread. You simply sell a put option at a spot that you don't think the stock will get to, and you buy yourself a protected put option below that area. And here you see the chart of IWM on the day I did this trade. And one reason why I did this trade is that IWM was in a nice bullish uptrend. We see it made a new higher high, made a new higher low. It come down, tested that low, found support at the green 50 moving average, came up and pushed through this area of resistance and made a new higher high. Because of that, I felt comfortable doing a new bullish put credit spread in IWM. Now keep in mind what's going on here. Now I've put in the strike price of the put option we sold. It was down here at 208. As long as IWM was above 208 expiration, I'd have a win on this trade. I really could potentially have a win anytime between the day I did this trade and expiration if the trade went my way. I just didn't want it to have a big sharp decline, and I definitely didn't want it below 208 because that meant I'd have to adjust or close the trade out for a loss. So how'd the trade turn out? Well, IWM kind of meandered along. It continually found support around 217, and then several weeks later it had a big spike in price. On November 11th, it spiked up to around $240 per share. As a result, as you see here in this trade alert I sent to my patrons, we closed out this bullish put credit spread we'd entered at IWM for a nice win. It only cost us 6 cents per share to close it out. Remember, we got over 30 cents per share for it, so it's about an 80% win. I like to do bullish put credit spreads on stocks that I believe are going to go up in price, or at worst, just kind of trade sideways in a range. Those to me are the perfect times to trade bullish put credit spreads in stocks or ETFs. But one thing I don't like to trade through earnings if at all possible, and that's one nice thing about trading in an ETF, is that you're avoiding earnings. Now when you do these positions, you do have to have a plan in place in case the position goes against you. So here's those favorite words of traders: you need to know how to manage your risk. So my personal rule for this position was that if it was down the amount of credit I received, I would like to probably close the position out for a loss. Now I do have an exception for that because I'm an experienced trader. If it was at support or an area where I thought it might find support, I could overrule that position. But if it did not look like it was going to find support anywhere close to where it was at, I would exit the position, even if it meant exiting for a loss, which I'm going to show you I did on another trade in just a minute. So that one worked out for us. What about when they don't work out? Because I know a lot of YouTubers, they don't show the ones that go against them. They only make you think they win 100% of the trades, but that is not reality. So how do you handle the ones that go against you? Well, here's one that went against me. If we go back to July, you see a September expiration trade I did. I did the same bullish put credit spread in IWM. We got a nice credit when we entered this bullish put credit spread of 52 cents per share. Well, unfortunately for that position, we had a wild, crazy volatility spike. Volatility spiked over 300% in less than a week. Because of that, IWM had a very sharp decline of 13%, just a matter of about 3 days. So what did I do? Well, I took a loss. That position I received about 50 cents per share for. I had to close it out for $2.05 per share. So I lost about $1.50 per share. But to me, it was the right decision. The market didn't make sense. Volatility spiked for no apparent reason. I felt like something was going on in the market, and indeed, something was going on in the market. The market was crashing. So I didn't override myself in this position. I exited it for a loss, and that's what the stop loss rules are for. If you don't understand what's going on, and it doesn't appear to be about to find support, well, it might be time to exit for a loss. That's what the rule is there for. So although a lot of these go our way, and I mean a lot of them, when they don't, you have to act shrewdly. You got to make wise decisions. And that applies if you have a small account or a large account. You must make smart decisions when you're trading. Here's another type of option trade you could consider doing in a small account. I like to do these when I think a stock or an ETF is range bound. Now the first part is what we just described as our first strategy, which is a bullish put credit spread. You could add to that a bearish call credit spread. So you simply do the same thing. You sell a put option here, you buy a put option for protection below it. But then you do the opposite on the other side of the current price the ETF or stock is trading at. And here's an example of that. So we could sell the 210 put and buy the 205 put for protection. And if we thought IWM was going to be range bound, we could then do the other side of that. We could sell a call option at say 230 and buy the 235 call option. This trade is what's known as you see here, an iron condor. But you kind of want the stock to stay in that range between the two short options that you've sold. So in this case, we really want IWM to stay between 210 and 230 per share. Otherwise, we'll have to either adjust the position to try and turn it back into a winner or close it out for a possible loss. Doesn't mean you will have a loss. Depends on time decay and how far it's gone against you, but it might be a possible loss. But these are perfect if you think a stock is going to be range bound and stay in between two prices. As you see, it kind of doubles up the amount of premium you receive. You receive premium for the put option side and for the call option side. That gives you two strategies you can consider in a small account. Now here's the third one that I currently use. You could buy an option position that kind of looks like this. Let's say, for example, you were bullish on the Russell. Well, in this case, I'm trading a larger Russell in this account I'm trading this in, but I'm doing a bullish call debit spread. That means I'm coming out of pocket when I enter this position. My theory here is I believe that the Russell will go up in price during this time frame. This time frame here is 65 days. So I buy a call option that's slightly out of the money. You can really buy that call option anywhere. You can buy it at the money, in the money, but you buy a call option, and then to help pay for that option, because remember, it'll be time decay involved in that call option you're buying, you sell a call option above that. And here you see an example of what that profit and loss will look like. So I'm going to zoom in here. Let me tell you how this works. So down here is the price of the underlying stock, and here's your profit and loss. And this is the day I did this trade. So I was right here, this little red dot. It was red because I was showing a loss because of the commissions. So notice what happens at expiration. If the stock goes up, this is my profit and loss line as of today. Then I could potentially have a win. If it goes down, then I have a loss. And at expiration, the profit and loss will be at this thick blue line here. So if at expiration, let's say the stock is at $22.50, well, I show a profit of about $2,000. Conversely, if it was at $2,000, I'd have a loss of what the position cost me, about $2,000. These are nice because it gives you a chance to win, but you have minimal risk. In this case, we have about a 1-to-1 risk to reward ratio. These are ideal to do when you believe the stock is going to go up in price. And of course, you could do the opposite if you thought the stock was going to go down in price. You could buy a bearish put debit spread. So that's the third strategy I like to use in a smaller account, and actually use this in one of my larger accounts right now. But it's a nice way of capping your risk and still giving you potentially nice rewards. Actually, I almost forgot here. I wanted to show you what happened with this trade. Notice we entered it on September 11th. See, days in trade is 0. So this is when we entered it. And if I slide myself up here, you see it cost me right at $2,023 to enter this trade. Well, fast forward 22 days. As you see here, we're days in trade 22. And indeed, the Russell had gone up. Hadn't gone all the way up, but it had gone up. So we had a profit, as you see down here, of $646. This is the day that we exited this trade. So we exited it for a nice win. Now, the fourth strategy you might consider using in a smaller account, which again, all these apply to large accounts as well, so you could use this in a small or large account, is if you believe a stock is undervalued, you could buy a longer term call option in it. So what would that look like? Here you see the option chain of CAG. This is a company I believe is undervalued, but it has been getting beaten down. And its technicals don't look great right now, so I'm not encouraging this trade by any means. In fact, I don't encourage any trade I do. You should do your own research. But I'm looking for the stock to kind of stabilize, and if it does, I might buy some longer term call options. Those are known as LEAPS call options. Here's what that might look like. Here we see CAG is trading for around $25 per share. Well, if I was bullish on CAG, I might buy a longer term call option. Here you see this option expires in 709 days. So I could buy the $23 strike price call option, and notice that last traded for about $3.98 per share. So think about that. How much am I out of pocket to control 100 shares of the stock? Remember that each option contract lets you control 100 shares of a stock. So if I were to buy the January 15th option that expires in 709 days, it will cost me $3.98 per share, or $398 to control 100 shares of CAG. Now compare that $398 to what it cost me to buy 100 shares of CAG. That would cost me 100 times $25.07 per share. Or if you do the math, it cost me $2,109 more to control 100 shares by buying the stock as compared to buying this longer term call option. And now we see the market just opened, so we see our numbers starting to crank around here, which is always fun. But notice I'm spending a lot less money to control those same 100 shares. And in order to win, all I would need is for CAG to be above the cost of that option plus the strike price by expiration. I've done the math here for you. The strike price is 23. It cost me $3.98 per share. So I would need the stock to be above $26.98 per share in 709 days to win on this position. And remember, it cost me under $400 to control those 100 shares. Using LEAPS options is a nice way to control shares on companies you believe are undervalued, and over the long term, they're going to go up in price. You just want them to go up in price before your expiration day. Now, there's more to Leap's options than what I just shared with you. And I have a whole video series dedicated to Leap's and poor man's covered calls. So before you trade in them, please watch that entire video series. It'll help educate you to the advantages and disadvantages of using Leap's or longer term options. As you've seen here, these 4 strategies are all the strategies you need to trade options in a small account. But they can also be done in a large account. In fact, I use all these strategies in my small and large account. Please make sure before you do any trade, option trade or stock trade, that you completely understand the risk of what you're doing. If you don't understand the risk, just paper trade until you do understand the risk. We want you to keep playing this game with us forever. If you'd like to get an alert whenever I buy stock or sell options, check out the benefits of becoming a patron down at the link in the description below. One of the strategies I mentioned in this video for small accounts is selling put options. To see several real-life examples of how I sell put options in my small account, check out the video at the link above and description below entitled How to Sell Options with a Small Account. Until next time, happy investing, and we'll see you again soon.